In 1929, the world felt rich. The stock market soared. People borrowed money to buy stocks. They thought the good times would never end. Then, the market crashed. It was called the Great Depression. Millions of people lost everything. Their savings vanished. Their jobs disappeared. It was a time of great pain and hardship. Today, in 2025, we see the same warning signs. The air feels the same. The optimism feels fragile. Many smart people say history is repeating. The same dangerous ingredients are present, waiting for a spark. We see wealth concentrated in the hands of a few. We see people and companies borrowing huge sums of money. We see wild speculation in assets that produce no profit. These are giant flashing red lights on the dashboard of our global economy. The system is stressed. It is stretched to its breaking point. Just like the late 1920s, belief in permanent prosperity blinds many to enormous risks building up beneath the surface. It is a dangerous illusion that could shatter at any moment and catch millions unprepared. The story of the 1920s was one of a new era of economics. People believed stocks could only go up. They invented new reasons to justify impossibly high prices. Today, we hear the same arguments about new technologies changing everything. We are told old rules of value no longer apply. This is classic bubble thinking, the same mindset that led investors off a cliff in 1929. We must see the world as it is, not as we wish it to be. The purpose here is not to cause fear, but to create awareness, to give you information to protect yourself. We will look at the facts, examine parallels then and now, discuss why this time could be worse. Outline simple, practical steps to safeguard your wealth. The storm clouds are gathering. Wise people do not wait for the rain to start before they build their ark. The time to prepare is now, before the storm hits and it is too late to act. The first major parallel is extreme wealth concentration. In the late 1920s, a tiny fraction of the population owned most of the country's wealth. The top 1% held a massive share of the stock's bonds. This created a very unstable economy. When this small group of people got scared and started selling, there were not enough buyers to support the market. The entire system collapsed. Today, we see the exact same pattern. The gap between the rich and everyone else is wider than it has been in nearly a century. This concentration of wealth makes our financial system incredibly fragile and prone to a sudden, sharp downturn. The second parallel is extreme leverage. Leverage simply means using borrowed money. In the 1920s, people borrowed heavily to buy stocks. This was called buying on margin. When stock prices started to fall, their brokers demanded more money. People had to sell their stocks to pay their debts. Today, leverage is everywhere, and it is at record levels. Households have massive mortgage debt, credit card debt. Corporations have borrowed trillions. Governments are the biggest debtors of all. This mountain of debt acts like gasoline poured on a fire. A small problem can quickly become a massive, uncontrollable crisis. The third parallel is a speculative mania. In the 1920s, people bought stocks not based on the company's real value, but on the hope that the price would go up forever. They invested in companies with no profits purely on speculation. We see the same mania today. People are pouring money into assets with sky-high valuations and no history of making money. This is not investing, it is gambling. While the parallels to 1929 are frightening, our situation in 2025 is worse, for several key reasons. The first is global interconnectedness. In 1929, the world was connected, but not like today. Now, financial markets operate 24/7 across the globe. A crisis that starts in one country can spread to all others in a matter of hours. Our economies are deeply linked through trade and finance. A problem with a bank in Europe or Asia can trigger a chain reaction that brings down the entire global system. This interconnectedness means there is nowhere to hide. The speed and scale of a modern crash would be unlike anything the world has ever seen. The second reason is our dependence on digital systems and fragile supply chains. In the 1930s, people could still grow their own food or trade locally. Our modern world runs on complex, just-in-time supply chains that deliver food medicine. These systems are incredibly efficient but also incredibly brittle. A disruption in one part of the world can lead to empty shelves in another. Furthermore, our entire financial system is digital. Your money is just a number in a computer. A cyber attack or a systemic failure could erase wealth in an instant. In 1929, the world was on a gold standard. Money was tied to a real physical asset. Today, our money is fiat currency, backed by nothing but faith in the government that issues it. This faith is starting to crack. After 2008, trillions were created out of thin air and rates were pushed to zero. Temporary became permanent. Global debt is now the highest in human history. Central banks have limited tools left for the next crisis. They cannot lower rates much further. This leaves our system with no safety net. Mathematically, the path out is currency devaluation. Your money buys less over time. While the broader market shows signs of instability, a powerful and quiet movement is happening in the silver market. A silver squeeze is underway, and the data proves it. A squeeze happens when demand for a physical asset massively outstrips its available supply. The price of silver has surged dramatically. This year alone, it has posted incredible year-to-date gains, far outpacing most other assets. This is not normal market behavior. It is a sign of a fundamental shift. People are waking up, physical silver is rare. People are waking up, physical silver is undervalued. They are buying it in record amounts. That buying is putting immense pressure on a very tight market. We can see this pressure in the key market indicators. One of the most telling signs, London lease rates. A lease rate is what it costs to borrow physical silver. For months, these rates have been negative. It signals a severe shortage of physical bars for borrowing and lending. Big players are desperate to get physical metal. They are willing to pay a premium just to have it available. This is a 5-alarm fire. Loss of confidence in paper silver. Another clear sign. Rapid depletion of physical inventory. COMEX registered stockpiles have been draining for months. These are the bars available for delivery to buyers who stand for delivery. More buyers demand physical metal instead of rolling over their paper contracts. The vaults are emptying out. At retail, premiums on physical coins remain high. At retail, premiums on physical bars remain high. Demand from everyday people is relentless. The wholesale markets are screaming there is not enough silver. The retail markets are screaming there is not enough silver. Finally, the market is in backwardation. Normally, futures trade above spot. That is contango. Backwardation is the opposite. A classic sign of immediate shortage and distrust in future supply. Price surge, negative lease rates, draining inventories, backwardation. All point to one conclusion. The physical silver market is breaking. This is not a blip. It is a structural stress revealing itself. When multiple market signals align, the probability of a major dislocation rises. The window to secure physical metal narrows before price fully reflects scarcity. Prepare accordingly. The current squeeze on silver is not a temporary event. It is the result of a long-term structural problem. For 7 consecutive years, the world has used more silver than it has mined. We have been in a continuous supply deficit. Each year, we dip into above-ground stockpiles to meet demand. Those stockpiles are getting dangerously low. You can only draw from a well for so long before it runs dry. The years of deficits are catching up, and the market is beginning to panic as buffers disappear. We cannot simply mine more on demand. Mining responds slowly to prices. Global silver production peaked years ago and has struggled since. It takes 10 to 15 years to find a deposit, get permits, build the mine, and produce metal. There is no quick fix. Supply out of the ground is relatively fixed in the short to medium term. Past low prices discouraged exploration. The pipeline is nearly empty. Most silver is not mined directly. Over 70% comes as a byproduct of other metals like copper, lead, and zinc. Silver output is tied to the economics of those base metals. Even at $100 silver, output will not surge unless copper or zinc economics also justify it. Result: a highly inelastic supply curve. Monetary demand is surging and supply cannot flex. Industrial demand is exploding too. The math is unavoidable. When demand collides with fixed supply, prices must go higher. You do not have to take my word for it. A growing chorus of financial experts is sounding the alarm. Their messages are clear, urgent, and consistent. Dr. Alasdair Macleod of Gold Money. He says the end of the yuan-backed dollar system is approaching. Sudden and catastrophic. Physical gold and silver protect purchasing power as central banks quietly accumulate metal ahead of a monetary reset. Peter Schiff calls the U.S. economy a bubble built on debt and Fed policy, worse than 2008. He warns of dollar reserve loss and surging inflation. Get out of dollars, dollar stocks, and bonds. Buy physical metal. Andy Schectman documents massive physical outflows. COMEX and LBMA vaults. Sovereigns are taking delivery in unprecedented amounts. Paper is disconnecting from physical. A day may come when you cannot get metal at any price. The window is closing. Across backgrounds, the consensus is overwhelming. Own physical gold and silver now. The situation is urgent, but you can take clear, practical steps to protect yourself. The first and most important step is to prioritize physical metals. This means buying gold and silver coins and bars you can hold in your hand. Do not get distracted by paper assets, ETFs, futures, or mining stocks. They carry counterparty risk. In a systemic crisis, promises break. Physical metal in your possession has no counterparty risk. It is your wealth. Use dollar cost averaging. Do not try to time perfectly. Nobody can. Buy a set amount of gold and silver on a regular schedule. Weekly or monthly, consistency smooths your cost. High prices buy fewer ounces. Low prices buy more. Discipline builds positions. Secure storage is non-negotiable. A quality home safe or an insured allocated vault outside the banking system. History is clear. Cycles repeat. When these conditions align, it is not if, but when. We are at a dangerous point in the cycle. We are sailing in uncharted waters, with a monstrous storm ahead. You cannot control the storm, but you can strengthen your vessel. Own what cannot be printed. Accumulate ounces. Secure your future. Act before the crowd. Prepare before the break. Your financial survival depends on it.